Good morning. Namaste. Happy Ugadi and Gudi Parva to all people from Karnataka, Telangana, Andhra Pradesh, and Maharashtra. Have a very happy new year. Okay, so this episode is about bonds. Recently, everybody must have seen a lot of advertisements about bonds. Some or most of the advertisements basically speak about assured, guaranteed returns for senior secured bonds. Okay. The advertisement is in such a way that it makes it appear that it's almost risk free, 9 to 12% returns. Now, many of our clients have asked us whether they should invest in bonds. While we are not financial advisors, we did some due diligence on bonds and how would, from a mutual fund lens, how would mutual funds behave around these bonds? So first of all, senior secured bonds give 9 to 12% returns. Sounds very, very good. In fact, so good that it's like too good to be true. Why I say that is because equity markets normally, fund managers say that long-term average returns for equity markets are in the range of 12 to 13%. Now, if secured bonds are giving that return, why would people put money in equity, which is far higher risk, right? I mean, we know what the market is doing today. So let's think. Returns are same as equity, but guaranteed. That I think is the first bulb we should light up. What are their credit ratings? So we examined the instruments which are supposed to give 10, 11, 12, even 13% returns in yield in some cases. All of these instruments are rated below AA. Now, I'll not go into credit rating of instruments. That's a whole new chapter, and I'm sure you can have a look at this when you search online. Okay. But the very fact that all of them are rated below AA, the ones that are promising these kind of returns, okay, should again be an alarm signal. The third question we asked ourselves was, are mutual funds, there are a lot of debt mutual funds, right? So there are corporate bond funds, there are dynamic bond funds, there are gilt bond funds, gilt with constant duration, a lot of bond funds, even the various other kinds of debt funds, short duration, ultra short duration, long, low, medium, uh, all of them in some way or the other invest in all kinds of bonds, right? So are mutual funds buying these bonds? So when we evaluated the mutual funds and even the category called credit risk funds, remember the name itself is credit risk, which means there is a risk of not being paid. Even the credit risk fund does not invest below AA. You can have a look at any of the credit risk funds and look at their holdings. You will find that their categorization, their holdings are between sovereign, AAA, and AA. None of them hold below AA. So if these kind of returns were being given, why are mutual funds not buying these bonds? That's the third question we asked ourselves. The fourth thing, which when we looked at markets around the world, especially in the most evolved market, which is the United States, recently for the last 3 to 4 months, there has been a spate of closures of private credit funds. By closures, I mean they are not allowing investors to withdraw their full money. Essentially, it means that they don't have enough liquidity to enable people to withdraw their money when they like. Today, private credit funds in US have a total asset within quotes, assets mark to market, almost $2 trillion. Apparently, most of those are under stress. If you look at the bonds which are giving 9 to 12% returns, okay, they are actually in the asset category credit risk or even worse. Now, people may ask, okay, so let's look at triple A, okay, or look at double A. I mean, they are still giving 7, 8% or maybe 8, 9% returns, right? Uh, First of all, let's wind back some years. Okay. Anyone remember ILFS? Anyone remember Yes Bank? Anyone remember DHFL? All of these were rated AAA. All. We all know what happened with each one of them. So therefore, ratings by itself don't mean that everything is secured. No. Senior secured bonds mean only one thing, that if the company defaults, the bondholders, the senior secured bondholders, have a first claim on whatever is the salvage value of that company. That's all. So the fundamental check, what we would request everyone to do is that if something is too good to be true, please check again and again. Compare with various debt mutual funds and see what mutual funds do not buy. If mutual funds who employ a lot of well qualified, highly experienced people who have been in these markets for more than 2 decades, 3 decades, okay, they are not buying these bonds, there must be something, right? And it is not necessarily only regulation. Because remember, return on capital is important, but return of capital is equally important. You need your total money back, right? We would say FDs in some banks earn 8%, small finance banks. At least up to 5 lakhs is guaranteed by or RBI, right? If the bank goes bust, at least we get 5 lakhs, right? So, I mean, why not invest 5 lakhs in small finance bank 8%? Okay. Now, I will give my own example. I have invested some money in some of these small finance banks. One of those banks, I actually withdrew money when I observed that for last 4 quarters, they made losses continuously in last 4 quarters. Continuous loss-making bank, however attractive the rate of return is, the interest rate is not a good sign. Okay, so I took out my money and put it back into one of those large, too big to fail banks. On that note, HDFC Bank is down today, okay, because their chairman resigned because essentially his letter said not everything is good with the bank. That's all. So we would request you to focus on capital protection as well as return on capital. So don't just focus on just return on capital. So we hope that this short presentation has been useful to you. We would urge you to always be careful with your money. As always, we are mutual fund distributors. We have a fiduciary responsibility towards our clients. Mutual funds obviously are not guaranteed returns. Mutual funds are subject to market risk. So please read the offer documents carefully. And past performance do not guarantee future returns. Thank you. Namaste.